After weeks of anticipation and tensions, Russia has finally made its move in Ukraine. Russia has so far targeted multiple cities in Ukraine and seems to be marching towards the capital, aiming for a regime change. Russia's incursion in Ukraine is nothing new. In fact, in 2014, Russia annexed Crimea, however, without much of a conflict. And since then, the eastern part of Ukraine has been subject to frequent conflicts with Russia through the separatist movement. Since the invasion, clearly financial assets suffered a sell-off. Volatility rose across most risky asset classes. Investors also bought risky assets as a hedge against these geopolitical risks. Let's look at some of the potential scenarios that could happen with this geopolitical conflict. In our view, the base case is that the Russian attack is likely to be limited both in scale and in terms of duration. That we ascribe a 60% probability, and associated with that, we anticipate a potential sell-off of roughly 15% in the equity markets. In terms of the impact, clearly the impact is the most severe for Russia, as most Western allies impose crippling sanctions on Russian corporates, financial institutions, as well as the central bank. Secondarily, Europe will have more collateral damage under this scenario, given its dependence on Russia oil and gas, and this is likely to lead to more elevated inflation and a potential slowdown. In terms of the economic impact to the United States, the impact is likely to be more modest, as the US have limited trade with Russia and limited dependence on Russian oil and gas. However, the US is still subject to global energy prices, which is likely to stay high under this scenario. Under a more severe scenario where the war ended up more protracted, leading to large civilian casualties, we expect a more severe market response, which could lead up to 25% sell-off in the markets. That we ascribe a probability of 30%. Sanctions will be imposed and Russia will be economically isolated from the rest of the world. This will lead to a massive economic crisis in Russia, and the corresponding impact on Europe is likely to be greater, especially if Russia were to unilaterally cut off its oil and gas supply to Europe. The impact on the US is largely transmitted through the stock market, as well as through higher energy prices, which will affect consumer confidence and cause inflation to rise even higher. Russia may be a fairly large economy with a total size of 1.5 trillion US dollars. However, Russia has limited trading relationship with the rest of the world, and the impact of this conflict and the associated sanctions is unlikely to come through trade, but through oil prices. Europe is very dependent on Russia for energy products. In fact, close to 30% of its oil and gas needs are fulfilled through Russia. So under a protracted conflict scenario, we expect Europe to suffer more economically and also face higher inflation. The banking sector is less exposed as compared to the past. With the exception of Austria, most other major EU countries have very limited exposure to Russian corporates and financial institutions. Hence, we expect an ongoing conflict is unlikely to tighten financial conditions materially or to create a systemic stress on the European financial system. How has the equity markets or financial markets reacted in an environment of ongoing geopolitical conflict? In fact, when we look back at prior geopolitical events such as the Gulf War, the Afghan War, the Iraq War, as well as the 2014 Crimean crisis, one thing stood out. Markets declined into an anticipation of a war. But as the war commenced, financial markets tend to bottom out into an actual invasion. The key takeaways of this analysis is that historically, most geopolitical event risks were passed without lasting economic impact. Economic fundamentals, those relating to growth and inflation, will dominate and assert itself. As the broader conflict materializes, history suggests that the market will be close to a bottom. As such, we recommend clients to start positioning into markets, whether through dollar cost averaging or through structured solutions given the elevated level of volatility, which can be used to build defensive payoffs. Thank you.
The situation continues to be extremely fluid. In fact, investors right now are grappling to understand what is really going on in the markets. Investors should not be looking to sell out right now and exiting at their portfolio. In fact, they should be looking for entry points. The Chinese word 危机, which means crisis in Mandarin, brings about opportunities in danger. As such, investors who are out of the market right now should be looking for possible entry points at this current juncture. After all, who doesn't like a discount? Investors who are already invested should be looking to top up the existing portfolio with good quality names and assets. Dollar cost averaging in the long run will definitely bring efficiencies into your portfolio. For the more conservative investor, think about diversifying your assets through multi-asset solutions. This allows you to manage your downside risk, but at the same time allows you to stay in the market and capture market rebounds. And this can be achieved through a suite of UOB solutions like Capital Builder, Income Builder, and even Simple Invest series. For the more invested customers in the fixed income space, look to invest in floating rate bonds and shortening the duration of your portfolio in view of rising interest rates. Sustainable bonds, green bonds for example, are enjoying tremendous global investment demands and solutions. Similarly, real assets like infrastructure, properties, and REITs are another means of diversifying your income streams. Investors can also consider megatrends. Megatrends are long-term structural drivers that are changing the world that we live in today. In fact, most of these trends are not affected by the outcome of this war. Take, for example, sustainable investing, ESG. After COP26, there are tremendous amount of initiative in this space, and this will create a lot of value in the long run. Similarly, shifting consumption patterns, the millennials, and the rising middle income in Asia is going to shape how companies are going to project themselves and present products in the future as well. AI, robotics, technology, for example, continues to evolve regardless of the outcome of this war, and the digitalization of this world will continue regardless. Healthcare, fundamentally, we like a lot because there's a global aging population that we need to take care of, and there's a lot of illness and diseases that continue to plague the world. China is another interesting opportunity. China is experiencing a very important political year this year. Similarly, you're also seeing a lot of central bank easing on that front, and they have a huge domestic market that insulates themselves from the current situation in Europe. For the more opportunistic investor, the ones with the right risk appetite of course, investing into US and European financials today looks attractive. After all, central banks around the world will start rising rates, and the net interest margin is likely to contribute to the profitability of these banks. Similarly, M&A activities that accounted for 5.6 trillion last year is likely to continue robustly into 2022. Gold, and to a certain extent, US Treasuries, are another opportunities that investors should be thinking of as a flight to safety. However, with hawkish Federal Reserves, there could be a cap in their returns going forward. Finally, sanctions is likely to affect oil prices, which eventually will put a dent to economic recovery as inflation rates will start to spike again. As such, investors should also be thinking about positioning or try to capture opportunities within Asia and Japan as they are further behind the economic recovery curve as the world continues to connect and also to reopen to itself. For more information and details, speak to your UOB advisor.